Thought leadership from PwC's National Office.
Welcome to PwC's Accounting Podcast. I'm Kyle Moffitt, PwC's professional practice leader and your guest host for this SEC-focused series. As with the rest of this series, we're taking a back-to-basics approach, but when it comes to SEC reporting, even the basics can get complex quite quickly. And from what I can see, what I see on a daily basis in the national office, these are real-world issues that come up across all industries and all deal types. So it's important to get them right, and it never hurts to get a refresher. A quick reminder, this is also a video podcast series. If you're listening to the audio-only version and want to watch the video, just head to the show notes for the link. Today, we're talking all things acquisitions and divestitures, from the filing and reporting requirements to key insights and reminders. So I think it's going to be definitely a lot for us to cover today. I'm joined by Scott Feely, who is our SEC and capital markets leader in the national office, and Liz Kriego, PwC's U.S. deals, clients, and markets leader. Welcome to you both. Really happy to have you on today.
Good to be here.
So, Scott, can you just start us off, just give us sets the stage for what we'll be covering today and why it's important.
Sure. Yep. Happy to do it, Kyle. So as you said, it's part of an SEC series. So we'll be focused on public company reporting requirements. I would say it has a little bit broader appeal than that, in that, certainly public companies will be interested, but anybody contemplating an IPO, you might even think about private companies that may sell a business to a public company. This may likewise be of interest to them. It's always a bit of a hot topic and can get interesting because it's inherently non-recurring. So even sophisticated controllership organizations may not step through these requirements all the time. In addition, large organizations may sometimes benefit from their sheer size, right? We'll talk about significance a little bit. But given the size of their organizations, that may render some of this less impactful to them on a regular basis. So again, non-recurring in nature. Say acquisitions and divestitures, of course, two sides of the same coin. Perhaps from a reporting standpoint, acquisitions may be a little bit easier, just because a registrant in an acquisition has to deal with their own reporting requirements, whereas in a divestiture, they certainly have to deal with their own reporting requirements. But they also have to, think about what the reporting requirements of their counterparty may be.
That's a great point.
So.
It's a great point. So just kind of given that as a backdrop, and before we get into the technical and practical implications, so all the reporting that we mentioned, Liz, you want to talk a little bit about just market update? What's going on right now? I mean, obviously, markets are all over the place. I think I've heard last week turmoil. I heard some positive comments today. I mean, it's all over the map. But as far as it relates to M&A, what are we seeing?
We're seeing a lot, and it's changing almost every day, right? The headlines. It's really challenging right now to be a deal maker. As you know, in the beginning of 2025, we thought the table was set. We'd have a more amenable deal environment. We'd have maybe less regulation, and maybe interest rates would go down. Many were expecting M&A to rebound. We usually see that when there's a new president, the new administration. You have almost policy certainty. And it seems like we've sort of traded election uncertainty now for policy uncertainty. A lot of deal makers were waiting on the sidelines, ready to press go at any moment.
And no one's pressing go.
So we looked at deal volume and value from Q1 of 2025. We compared it to Q1 of the prior year. And deal volumes and values are relatively flat right now. Yeah. I said it's really difficult to be a deal maker because valuations are really tough if you have an all stock deal and the stock market is extremely volatile. The geopolitical concerns right now, supply chain, obviously diligence is really key, really thorough diligence. But, these valuation models, deal models have to have such robust scenario planning right now because all options are on the table.
Yeah, that's what you think as you're talking about, it's like scenario analysis. How far do you go? I mean, that seems like it's almost impossible at least this early on in the Trump administration. It's completely unpredictable.
Also, organic and inorganic growth strategy is really impossible now because one day your strategy could just be pulled out the window and you have to come up with something very new.
Yeah.
So a low cost, maybe, for either labor or goods, could turn on its head in one day because of tariffs.
Right. Well, so I think that's as you think about where we are, you mentioned tariffs, you think about, so it's just the trade war, right, that we're in. And then obviously we'll see, I think, hopefully and see some tax action later on this year. And that's obviously the big talk on the Hill. So what can deal makers be doing now, given the volatility? I mean, you mentioned scenario analysis, but what else can they do, at least as they're looking at their portfolios, their own portfolios, or even potential targets?
Well, if you work in deals, everybody is extremely—
Which you do a lot.
Absolutely. We're very busy right now.
Yeah,
We're still busy. And the majority of our clients are staying very close to the competition. They're staying very close, obviously, to the news and these models that I was talking about. But they are critically evaluating their portfolios in very different ways than they did 1 or 2 years ago. You're looking at non-core assets. You're looking at what might not fit. And you're changing the way you scrutinize the business operations of your company. So many are looking at spins, RMTs even, that never would have been on the table before for some corporates, now are coming into the picture.
Right.
Really creative deals that are happening right now, and trying to just extract the most value that you can out of your portfolio. Volatility obviously offers a lot of opportunity, but you have to get ahead of your competition. Business model transformation is key. And really just staying on top of your portfolios and making sure that there's no bias in those reviews.
I think that's a great point. When you just think about management bias, or, it's you got to be very thoughtful in this environment, especially. So you mentioned earlier, Scott, you talked about it kind of being two sides of the coin. You have kind of the acquisition side and the divestiture side. So we'll start with, acquisitions, and, perhaps you can just talk a little bit about some of the potential reporting implications for registrants when they're contemplating an acquisition.
Sure. Yeah. So maybe I'll start by setting us up and saying that, everything that we'll talk about today in terms of acquisitions or divestitures, we're going to focus on businesses, acquisitions and divestitures of businesses. Okay. So the acquisition of assets that don't constitute a business they may come with their own reporting implications. We're going to ignore that. So while we have this focus on businesses, this is probably a good time to highlight that the definition of a business in GAAP is different than the definition of a business that's embedded in the SEC's rules and regulations, right? So under GAAP, you have ASC 805. It governs the definition of a business. From an SEC standpoint, when you start thinking about 8K reporting, 305 financial statements, pro formas, et cetera, we're going to look to the definition of a business in Article 11. And in Article 11, we'd say the definition focuses more fundamentally on the continuity of operations before and after the transaction. And it looks at factors like revenue producing activities, employees, customers, operating rights, and a variety of other factors. On the surface, you might sit and say, okay, I might expect that the definition of a business under 805 and under Article 11 are going to largely align. And I would say that that's probably true in most circumstances, but we do see deviations, maybe most noticeably when people are arriving at an asset acquisition under GAAP by means of the so-called screen test.
Yeah.
Okay, just because of the predominance of a particular asset, single asset in the acquisition. And so when you see that, you can arrive at a different outcome under Article 11. And while that principle can be true across industries, it's most notable inside of health industries and biotechs in particular. So just stay tuned to that when we're talking about a lot of these requirements, we're going to be focused on the Article 11 definition of a business. It's a bit broader than what you might otherwise see under 805.
Yeah, and I think that's always been a topic of conversation. I think when we would talk to clients, it's that confusion, and especially in the biotech space of like, well, there's one employee, like, it's a right to develop a compound. Like, really, what is it? What kind of financial statements are even useful, right? Well, that's obviously the secondary question.
Sure.
First question is, well, it meets the definition of business under, the SEC's rules. But I think, there's obviously a lot of noise about why don't the rules align? Because I think it would certainly simplify reporting. But I won't ask you why the SEC, did what it did with respect to that rulemaking. I'm sure it's in the adopting release. So if people are interested, they can take a look there. But I want to talk a little bit about, we just think about distinction between acquisition of a business versus an acquisition of assets. But let's talk about, like, to your point, the actual reporting implications. We're thinking about an acquisition of businesses.
Sure. Yeah. So I'm going to start with the simplest of the scenarios, and then we'll layer on a bit of complexities from there. So for the moment, I'm going to ignore registration statements. I'm going to ignore prospectus supplements. I'm going to ignore proxy statements. All of those.
Liz wishes she could do that when she's consulting with clients. Just ignore all these things,
yeah, exactly,
right?
Exactly. Okay. So when we get into 8K reporting requirements, existing registrant, if they consummate an acquisition of a business that is significant, and we'll talk a little bit about significance, they have a requirement to file an 8K within 4 business days of consummation. Okay, and in that 8K, they'll report things like the date that the acquisition was consummated. They'll describe the business that they acquired. They'll talk about the counterparty, the amount of consideration that was exchanged, et cetera. Again, that initial 8K is required to be filed within 4 business days of consummation, okay, of a significant business acquisition. On the acquisition side, there's a secondary requirement. Again, if the acquisition is significant, there's a secondary requirement to file an amended 8K, okay, within 71 calendar days from that initial due date for the first 8K. And in that amended 8K, they would include pre-acquisition financial statements for the target audited, as well as pro forma financial statements reflecting or taking the historical financial statements of the registrant and adjusting them on a pro forma basis to reflect the acquisition as if it happened on the first day of the earliest period presented. We're not going to go deep on pro formas here because there's going to be another podcast in this series that will.
Well, that's obviously, I think the thing that you highlighted, which is the unique piece, right, is you have the initial 8K, right, which is just going to include some of the basic information, right? You had an acquisition, the name of the entity, that sort of stuff. And then the amended 8K with more detailed sets of financial information, whether it's, historical financial statements, pro forma financial statements. You mentioned significance, obviously, and go into as deep as you'd like, but how does a company go about making that determination? I think oftentimes, and I know you probably deal with this a lot, right? Just the confusion and of thinking about materiality versus significance. And I think talk a little bit about the distinction there. The way
Sure.
that I always look at it is, look, there are 2 separate things here. It's significance, which is the formulaic test. Mm-hmm. The second piece is materiality, and that's a secondary question of whether you write into the SEC to try to get some sort of waiver or something like that
Sure.
of the financials. But I'll start with how you think about significance.
Yeah. So as with a lot of things, when dealing with the SEC, there are very prescriptive rules that will, tell you how to measure the significance of one of these acquisitions. Significance is different than materiality, as you allude to. So, from a disclosure standpoint and a set of historical financial statements or things like this, there'll be plenty of transactions that are material that will not trip these significance tests. Okay, so these significance tests are reasonably high thresholds, and I'll step through each of them here in a second. So what we have in terms of construct today was the result of rulemaking back in 2020. Okay, and prior to that, we saw a lot of volume that would go into the SEC under the old construct for significance tests, where registrants were measuring significance. They were following the rules to the T, and what they were getting was something that they thought was really anomalous, right? Mm-hmm. That the test was saying that they had a significant business acquisition, but they thought the test wasn't really reflecting reality, and so. You saw a situation where registrants would write a lot of letters into the SEC to try and explain their position, and you allude to this, and you were there for a lot of this.
Process a lot of those letters, yeah.
Where these letters would go in, and they would make their case to say, we think we're getting an anomalous outcome. Either we don't think we should be subject to any of these reporting requirements, or we think we should be subject to reduced reporting requirements. Well, in 2020, we got new rules that I would call it codified a lot of the bases that people used to write in for relief on. Okay, yeah. So we see a lot less relief requests for relief. So
you're seeing less. You're seeing less, or you're also seeing less. you don't have to write in as much as you used to under the new rules.
I completely agree.
Yeah. So so definitely come a long way from where it was. And I guess my kind of follow-up question to either or both of you is, are we seeing companies oftentimes just looking at saying, well, this doesn't make any sense, it is significant, and then just jump right into like, okay, this is not material. We don't have this information. We don't want to even have to get these financial statements, audit these financial statements. This is like what's the reaction to that? I mean,
well, I would say two things. I would say, if a company could not have a reporting obligation, right, for the pre-acquisition. These are not easy lifts, right? Pre-acquisition financial statements for target companies. So, undoubtedly, if they could avoid that, they'd be happy to do it. But I would say on the flip side, we see far fewer instances where companies step through, and I'm going to talk about the revised tests, the mechanics of it here in a second. We see far fewer instances where companies step through the revised tests and come out the other side and say, I've got a result that doesn't make sense. Okay. Again, because we got these changes in 2020, maybe let me step through shall I step through
that'd be great.
The three tests? Okay. So you've got a test that is built on, I'll call it three legs. And on one of the tests, there's two sub legs. Okay. So we have an investment test, we have an asset test, and we have an income test. On the acquisition side, when we're dealing with the investment test, we're going to look at the consideration transferred, think purchase price, as a percentage of the worldwide market value of the registrant. Okay. And if they have no worldwide market value, you think pre-IPO, right? We'll look at assets, okay, for the denominator. On the consideration transferred, we'll consider everything from a GAAP standpoint, including, contingent consideration, either at fair value, if it's required to be recognized by GAAP at fair value, otherwise, the maximum that could be payable. We think about worldwide market value in the denominator. That's voting and or non-voting common, but it has to trade. Okay, it has to be traded. The idea here is that you want something that's really objectively determinable, right? And so it's the last 5 trading days of the month preceding the earlier of announcement or closing. Okay, so that's a bit of a mouthful, but this test was restructured and was really intended to yield, outcomes that were more reflective of reality, right? It's a fair value to fair value test, numerator and denominator. So the second test is the asset test. It's just what you might
pretty straightforward.
Just what you might guess. Okay, it's so the target assets pre-acquisition as a percentage of the registrant's assets pre-acquisition. What percentage does that yield? Okay, the third leg, and you're gonna take each of these 3 percentages, and you're gonna ultimately take the highest of the 3. Okay. The third leg is the income test. And you have to stick with me here a little bit because there's 2 sub-legs to this, okay, which could get a little bit convoluted. So recall that we have the 3 tests. We're going to take the highest observed significance of each, investment, asset, income. In the income test, you have 2 sub-legs, and you're actually going to take the lower of those 2 components, okay? One is a pre-tax, what we call the pre-tax income component. And one is a revenue component. Okay. So on the income component, you'll deal with the absolute value of the registrant's equity and the target's net loss from continuing operations before income taxes. And you'll take that as a percentage of the same metric for the registrant. Again, absolute values that you'll always have a positive result. You're dealing with continuing operations. So discontinued operations would be excluded from the test. Et cetera. This is a pretty volatile test because income can be volatile. Think I've got a big impairment in one period that either drives up a numerator or down a denominator.
Right?
Exactly. Yeah. Exactly. So that can generate a lot of volatility. And so in this 2020 rulemaking, what we got was a second component of the income test, which we call the revenue component, which was thought to be a bit more stable. Maybe a bit more reflective of true significance. And so again, this one is just what it sounds like. Okay, registrant's proportionate share of the target's consolidated revenue from continuing operations as a percentage of the same for the registrant. There's a few conditions that you have to meet to
Yeah.
Avail yourself of this test, including each component has to have material revenue, et cetera. But this has reduced tremendously. We talked about the decline in volume of waiver requests.
Yeah.
That is a big driver of it.
Yeah. I mean, I think like to your point, just kind of layering on, it really is. You look at a company as being acquired, and let's say their revenues are like 5% of the total revenues of the company that's acquiring them. But then you look and they're kind of in a break-even state, right? Then it's obviously going to always trip significance from a income or, perspective. And so I think that balance, and then you're looking and saying you're taking the lowest. So you're looking at, in that case, you're just taking the revenue outcome, 5%,
right? In your fact pattern.
Right.
Yep.
And then you're saying that's the and so that's my number when I'm looking at the investment, asset, and income test. The income test is at 5%. Good to go on that. However, the other two, if they're tripped, then I may still have to provide financial statements.
Exactly.
And I think you'd also look and say, well, maybe there's a reason. Like in a lot of times it is, the outcome could potentially result in a write-in to the SEC for a potential waiver.
Sure.
If the company believes that it is anomalous and not obviously material set of financial statements, which is again different and distinct from how we think about significance.
Exactly. Yep. So we didn't say it, but when you take the highest of the three tests, right? The mark you're initially looking for is 20%.
Yep.
Okay. If you're north of 20%, you're quote unquote significant. And there's a reporting obligation that comes along with it to report that acquisition on an 8K. If you're below 20%, you may have obligations under GAAP to disclose it in the footnotes to the financials, prepare pro forma financial information under ASC 805, et cetera. But you're not significant for SEC purposes under 20%.
I think that's a great point. So anything else from a kind of a significance perspective to add on that? And then potential impacts.
So I'll say in terms other than the binary, consideration around is it significant or not significant at 20%, right? Do I have to report it on an 8K or not? The level of significance. So if you exceed 20, the degree by which you exceed the 20% will dictate how many years of what periods you need pre-acquisition financial statements for the target. Okay. So again, if you're less than 20%, you're not significant. There's no 8K. There's no pre-acquisition financial statements for the target. If you're greater than 20%, but less than 40%, you will need 1 year annual pre-acquisition financial statements for the target, plus, to the extent there is one, a year-to-date interim period, right? The period between the latest balance sheet and the last year end. If you're unlucky enough to exceed the significance test at the 40% level, you're going to max out on these requirements, and you're going to need 2 years of pre-acquisition financial statements for the target, as well as year-to-date interims to the extent there is one, with comparatives for that year-to-date interim period.
Right. It's a lot to unpack there. And I think, when kind of thinking about that, then it's also the implications in the context of registration statements. Can you talk a little bit about that and how companies should be thinking about it? Like the one thing I think about is kind of the nuanced one where you may report an acquisition, a target, right, of an acquisition. You acquired the business and you filed 2 years of financial statements. But because it's a target in the Form S-4 itself, you may need to have 3 years of financial statements, which is a bit a bit strange, right? I know we talk about that a lot of kind of that distinction. But what else should companies be thinking about?
Yeah, so maybe I'll add a couple of points here, and then I want to go a little bit deeper on the registration statement proxy. So maybe we'll push that off just a little bit. And maybe what I'll add here is that while we're still talking, I'll just finish out on the 8K. While we're still talking about 8K requirements, I'll say that all of those pre-acquisition annual financial statements, whether it's 1 or 2 years for the target, those need to be audited. Okay, so just for the avoidance of doubt, those need to be audited. That audit can be performed in accordance with AICPA standards. Doesn't need to be,
but not ISA standards, not international, right?
Not international, no, and doesn't need to be PCOB. So it can be performed by a firm who's not necessarily registered with the PCAOB. And then I would say that, audit standards aside, once you're filing financial statements, even for a private company that you went and acquired, right? Once you're filing financial statements with the SEC, they're going to be what we would call SX, or they're going to need to be SX compliant financial statements. Okay. So think like you have private company accounting alternatives that have been applied in those financial. That's not going to work from an SEC standpoint. Okay. So there can be a fair amount of work involved in these acquisitions, even outside of the registration statement and other transactional environments that we're going to speak about, just to deal with the 8K reporting requirements.
I think it's a great point. And I think it's always one where you're always going to comply with GAAP. There are GAAP requirements for a lot of this stuff, but there's also SEC reporting requirements. And so it's important to ground yourself in the form, right? What form needs to be filed. That's going to drive what information is included in the form. And then, of course, the rules are referenced there. But your point, you said you wanted to unpack the Form S4, the target, a little bit more.
I can. Yep. So, and I'm going to do this by a little bit by difference to what we establish a baseline for the 8K. So I'll deal with registration statements perhaps first and highlight. There can be a lot of nuances here. Okay?
Oh, yeah.
So
absolutely.
I'm just going to highlight three
big ones.
Nuances that people ought to focus on. Okay. So recall that with an 8K, we talked about consummated acquisitions, right? That's your trigger for filing that initial 201 8K. When you get into registration statements, you're going to have to think more broadly about the possibility of probable acquisitions. Okay. So not just closed acquisitions, but probable acquisitions. There's a bit of relief built into this process. Okay. In terms of if it's probable, or in fact, if it's been recently consummated within the last 74 days, there's some relief built in to say you can go effective with a registration statement if you have something that's probable or recently consummated, as long as it doesn't exceed third threshold, 50%.
That's right. Yep.
Significance. Okay. And the idea here is that
just layer on another rule.
Yeah, exactly. The idea is that if it's greater than 50%, at some point it becomes so significant that you just can't, you can't proceed with a new registration statement without those financial statements. Okay.
Yeah.
And so you will have heard the term probable in there. We're generally going to defer to the company and their legal counsel, in making that determination, but they'll consider things like deal timelines, financing contingencies, maybe the antitrust process, things like this. And then I mentioned recently consummated. So that's really a concept that exists. If you think about the 8K requirement that we talked about, where you have, 4 business days plus 71 calendar days to get, these target financial statements on file. If you didn't have this type of relief, you would functionally be blacking people out of the marketplace, right? And so if it's not north of 50% and it's recently consummated, you can proceed, and it's really intended to largely align with the 8K reporting requirements for an existing registrant. So that's maybe one nuance, is if it's probable or recently consummated, greater than 50% in a registration statement environment, we need to be thinking about it.
I think the message there, right? And I think it's probably how all three of us, when we talk to clients, because we've been on calls together talking to clients, it's the message is always, look, if it's material, like you kind of that needs to trigger in your head. There's got to be something that's required by the SEC, right? For them to make an informed investment or voting decision in, a company and the purchase of stock or whatever the investment might be. So, anything else that you wanted to add before I switch gears and let Liz start to talk a little bit about
let me hit one other nuance, okay, which is individually insignificant acquisitions in a registration statement. Okay, so in an individually insignificant acquisition, so they're below 20%. But if you think about a serial acquirer, okay, who is constantly closing acquisitions, they're always individually below 20%. Maybe I won't say a lot on these, other than to say that if that's you in a registration statement environment, there's a possibility that you may have either a pro forma requirement to address, those financial statements, or in certain instances, to accelerate a requirement to provide the pre-acquisition financial statements for the target. Okay. So again, we don't need to go deep here, but if you're a serial acquirer, you're not in a registration statement environment, you're not automatically out if it's below 20%. Okay, if you have a lot of them that are below 20%, you may run into another.
It goes to that point that I made about materiality, right? If it's something's material, it definitely is something that should be considered. So go ahead.
Well, I just wanted to mention, Scott, you just mentioned 3 nuances, and there are so many more, right?
Yeah.
I have been a part of our advisory clients deals where I've seen corp dev folks come into the room to the chief accounting officer or the CFO and say, we want to buy this target. What's it going to take? What's the timeline? It's always the first question, right?
Yeah.
What do the accounting people and the financial reporting people need? And if you don't understand these nuances, if you're not planning for these things up front, you're going to get yourself in trouble, because it does take time to have audited financial statements of the target generally, right? How many years? If you're on the cusp, right? These can be very tricky decisions.
I think that's a great point. And I think it's the corp dev example, which we see it, right? And in every company, at least they see it internally. And so I think it's a fire drill, right? And so absent, like this is why it's important to really engage the right people and have them along for the ride. So when you're dealing with those conversations, you're in the trenches, and there's obviously a lot of practical implications of their M&A related activities. So what should our audience be thinking about? What should they have their eye on when they're thinking about acquisitions? Like anything that jumps off the page to you that, hey, look, keep this in mind.
Absolutely. And here are some practical considerations where I've seen our clients or others maybe not pay enough attention to that can cause some problems down the line. For example, a robust closing balance sheet, something that you're going to get from the target's accounting staff. However, if it's late, if they don't have a robust accounting department, how are you going to be able to do that opening balance sheet on time, right? So those are things that lag in timing is always key. So that's where there should be definite coordination between the 2 accounting teams, understand what you're going to get and when, get your auditors comfortable with the level of detail that's going to come through and come over. This late data, it can create a nightmare for some.
Yeah.
Pro forma financials, they're not just a check the box exercise. You have investor relations looking at this. You have potentially synergy disclosures in them. It's really hard to sometimes decipher what is appropriate to put in your pro forma financial statements and what is not.
She is teeing up our podcast that we've done on pro formas. You are all over this. This is great. This is great.
I think also, system capabilities, local controllership has to sometimes get involved in push down accounting. If you elect push down accounting in a global ledger, or maybe a ledger that's really not fit for another company to come on from an acquisition, you might get into some trouble in terms of the mechanics of pushing those entries down. Mm-hmm. So that's when you take your fair value PPA adjustments, you're pushing them down to maybe sometimes even to your local ledgers. You're recalculating things like depreciation, amortization. You're even looking at functional currency determinations, right? There's a lot to think about, and it has to be this organized effort. The other thing, divestiture is in reverse, which is kind of a weird concept, but it's when you acquire, you're making an acquisition, and you're immediately maybe going to sell off a piece of that target, or even combine it with a piece of your company that's already existing, merge the two, and then potentially sell. That was
terminology I kind of picked up being here at PwC, dealing with our deals folks, right? Because at the SEC, it's not something that they necessarily talk a lot about, but certan't see it a lot, right?
Well, I had to Google that, and I also used our AI accounting research assistant. So
there you go.
It is a term.
Yep.
But, in that scenario, you would have to think about potentially new segment reporting, carve out financial statements that might be needed, and your potentially new internal reporting structure, right? So I think I'll just end it with the cross-functional coordination is really key. People always say, don't forget about tax. Don't forget about the accountants and the financial reporting folks, the valuation teams. Everybody has to be lockstep, including corp dev, investor relations. You're also probably going to be asked to track post-close synergies. That's really hard to do.
Yeah.
Maybe you'd like to get off of TSAs faster, recording recognition of TSAs. There's just filing deadlines. Early alignment is key.
Yeah. No, those are all fantastic points. And I think I think the biggest one when it comes to any kind of reporting issue, right? Any reporting topic that's new, is ensuring that you're coordinating, right? You're coordinating with the right people at the table, internally and externally, the right advisors. And obviously, it's some of this stuff is to your point, there are deadlines, right? There are deadlines to the SEC reporting. If you don't hit those marks, then you may not be eligible, let's say, to use Form S3, or you may not be a WIXI. There may be some other things that could negatively impact your ability to raise capital moving forward. So cover the basics in terms of SEC reporting obligations for existing registrants, and understand it's obviously complicated for an entity contemplating an IPO, an existing registrant intending to raise capital, or even existing registrants that's actually dealing with an issuance of shares to affect an acquisition, which we talked a little bit about, target financial statements. But can we cover some of those nuances? And I think it's probably to you, Scott, to start with you.
Okay. Yeah. And so we covered off some of the nuances that come with new registration statements and, individually significant acquisitions and the need to potentially aggregate them and so on and so forth. So a couple of other unique transactional documents or considerations that people also ought to consider when they're thinking about acquisitions. One of them you alluded to earlier. So we start talking about a proxy or an S4 or a joint document to affect a business combination. So either a vote or shares being issued to affect a business combination, shares to the target shareholders. I would say pretty simplistically, once you're asking someone to vote, you don't get any breaks. Right. Okay. You're asking them to make a discrete choice on that transaction. There are no breaks, and so significance kind of goes out the window to some degree. And unlike in 305 that we talked about earlier, where if you're north of 40%, you're going to need 2 years of target financial statements. In the vast majority of scenarios with a proxy and S4, you're going to need 3 years of pre-acquisition financial statements for the target. There's a few exceptions to that involving, smaller reporting company accommodations, maybe some limited exceptions for a registrant who's an EGC who's yet to file their first annual report. But again, by and large, if there's a vote happening, people need to be thinking about 3 years of target financial statements. And then maybe the last transactional nuance that I'll hit is prospectus supplement. So this, of course, is when you have an already effective registration statement that you're going to draw down on via a prospectus supplement. Okay, ordinarily an S3. So the underlying registration statement would have had the financial statement requirements assessed at the time it went effective. Once you go effective now, and you want to draw down, now you're into what we call a fundamental change model, right? And that's a pretty high hurdle. So you might have a significant business acquisition, okay, north of the 20% that we talked about earlier, that doesn't constitute a fundamental change and won't necessarily need to have its financial statements included in a document, to draw down on.
And so let me ask you this: fundamental change. Who's the one that makes that call?
Yeah. So that, as we said earlier, in the context of a different concept. So this probability concept, this is another one where, fundamental change is, clearly in the domain of company and their counsel. Right. And so we will defer to them to make that determination.
Gotcha. So let's switch gears. We're going to hit the other side of the coin. And it was interesting as we were preparing for this, Scott, now you were out of the room, and Scott said, maybe we need to, her title might be this divestiture champion. Like, you're the one that knows all things about divestiture. So I think it's great that we have you to sit and talk a little bit about kind of, what we're seeing there.
Thank you, by the way, Scott, for the title.
High hopes for you. Yeah,
exactly. No pressure here. And, Scott said earlier that divestitures may be more challenging, I think, than acquisitions. But I think there's a reason for that, which is when you're an acquirer, you are only thinking about the target and how it relates to your books and records, your accounting policies, and how the pro formas and the go forward combined companies will look. When you are reporting a sale and you're undergoing a separation, you're not only thinking about your own books and records as the parent company, but you're thinking about the divestiture company's financials as well, the standalone carve-out financial statements. So from a parent company's perspective, undergoing a separation, things that you would think about would be when do you file, your 8K, for example, for a significant disposition if it does reach that threshold. Things like held for sale, discontinued operations thresholds. You could potentially need to resegment your business based on the impacts of that separation. But you also incrementally need to think about the carve-co or divestco's reporting requirements as well. And that's where you have to think about who's going to use these financial statements. So who are the readers? Practically the timing of when this is going to be needed, and if they're going to be needed, either from a diligence perspective to maybe give more assurance to the deal, to the buyer, or even from a regulatory requirement perspective.
No, I think those are great points. And, it's just, I like the one thing you were saying is who's the reader, right? And I think a lot of times that kind of gets lost. And I can tell you that as, the SEC staff, when they're looking at disclosures and they're thinking about it through that lens, who is the user? Who is the intended audience for this? And it's going to drive obviously a lot of comments that they issue. And I think putting themselves in those shoes, I think probably would help them highlight, any issues that might arise in the process.
Well, I was just going to say, interestingly, you speak to the reader. So if we're talking about the registrant's reporting obligations, it may be clear, right? It's the registrant's investors. What's really interesting about divestitures is certainly early in the process, the pool of possible readers is potentially very large, right? Because companies may contemplate, not only multiple possible buyers for a business, but multiple possible paths to effectuate the divestiture itself, right? They might run a spin path side by side with a sale path, and that sale path could involve, existing registrant buyers, private buyers, et cetera, right? So trying to anticipate all of those needs can be really, really complicated in a divestiture.
Especially because no accountant, no chief accounting officer ever wants to say, this deal needs to slow down because we don't have the financial reporting requirements.
That's the last thing that you'll ever hear, right? Exactly. You wish you hear that more often. Anything else to add to that before we move on to just the reporting obligations of the registrant? Scott, you want to?
Yeah, so I'll start with that. So again, we've got two, unlike the acquisition thing, we're going to break this up into two pieces. We'll try and do it pretty quickly here because we've got, some anchors to work with in terms of what we talked about on the acquisition side. So just focusing on the registrant and their reporting obligations initially. So as with acquisitions, I'll start with the basic, which is, no transactional documents involved. I'm just an existing registrant. I've sold a portion of my existing business. If that disposition is significant, there's that term again, but if that disposition is significant, similar to the acquisition side of the equation, I'm going to have an obligation to file a Form 8K, item 201, to report that disposition. As with acquisitions, that 8K is going to need to be filed within 4 days of consummation. And in that 8K, again, very similar to the acquisition side, you're going to deal with the date of consummation, a description of the business divested, the counterparty, and the amount of consideration involved. So up to now, pretty similar to what we talked about on the acquisition side. Unlike acquisitions, you're not going to have a requirement in an 8K to file standalone financial statements for the divested business. That could be different in a transactional environment. We'll talk about that in a second. And so you have no predisposition financial statements for the target. You do have a requirement to file pro forma financial statements, and you'll recall that with acquisitions, you have the four business days plus 71 calendar days to finalize all of that. With the disposition, you don't get that extension. This all needs to be filed in that initial 8K within 4 days of consummation. And again, I think that if you take one step back and think about it, it makes sense, right? Unlike in an acquisition where you don't control necessarily all of the information you need to prepare and comply with the reporting requirements, prior to close. With a disposition, you do, right? So you don't need you shouldn't need the.
Do you advise registrants to always hey, if you want to do something, make sure you consummate it on a Friday so you have Saturday, because it is the 4 business days, right?
Yeah,
right.
Exactly.
So,
it's 4 business days.
Yeah,
You can buy yourself a couple of extra days
Right,
that way. A long weekend is even better, right?
Right.
With a holiday attached.
That's right.
Yeah.
All right. So just kind of you mentioned a little bit about significance. And look, we obviously we talk a lot about that when it comes to SEC reporting, because there are these significance tests that are grounded in regulation SX. Is that the same concept as what we talked about for acquisitions, for the dispositions?
Yeah, same basic concept. So I'm not gonna say too much about that here. Obviously, it's a different perspective.
I knew the answer to that
right?
question. I just wanted to ask
Of
you to
course.
see if you get it right.
Yeah, okay, I appreciate that. Yeah, so it's really just a mirror image, right? So instead of the consideration paid, you might be focusing on the consideration received instead of the pre-acquisition, pre-tax income or revenue of the target. You might be looking at what's being eliminated from the registrant. But in principle, it's just a mirror image of what you would do on the acquisition side. And that 20% threshold that we talked about on the acquisition side is the same on the divestiture side.
High level pro formas. Just we're going to have a separate podcast. People can look and listen to our podcast that's on pro forma financial information. But high level, what should people be thinking about if they don't have a chance to listen to that podcast?
Yeah, so maybe I'll just focus on a couple of concepts here, specifically related to dispositions, right? So, the pro forma requirements in some ways will hinge on how much is already reflected in the historical financial statements. Okay, think discontinued operations that may already be reflected there. And then secondarily, whether the disposition is going to qualify for discontinued operations or not in the first place, right? And we won't cover off how you're going to make that determination under GAAP, but it does drive different outcomes, right? So if you have a significant disposition that qualifies as a discontinued operation, and we will cover this in more detail on the pro forma oriented podcast, it's going to drive a requirement for 3 years of pro forma financial statements. Whereas if you have a disposition significant that does not qualify as a discontinued operation, you're going to be in the more standard 1 year plus interim period.
Yeah, gotcha. Okay, that was a lot to unpack. Anything else that either of you wanted to add before I jump to kind of maybe how to think about these? We think about the acquisitions. We talked about the complexities when it relates to another type of document, so a proxy statement, registration statement, prospectus supplement. Anything else? Or
we can go there.
Okay, so let's go there. So I know you're talking about when there's a vote involved. So talk a little bit about that and what the requirements are.
Yeah. So I would just say, again, I'll reiterate what I said earlier, where once, you're going to go ask your shareholders to vote, you don't get any breaks. Right. And so in the context of an 8K, I know I said no pre-disposition financial statements for the divested business. That's not true when we're talking about proxies or in some cases information statements. In those scenarios, you will need financial statements for the divested business in addition to the pro formas that we've already talked about. Maybe just moving quickly through some of these other nuances. So when we talk about new registration statements, very similar to the acquisition side. Recall that the 8K is triggered off of consummation. When we're talking about a registration statement, we're going to broaden the lens, open it up a little bit. We're going to look at both consummated and probable dispositions when thinking about, again, pro formas, not historical financial statements outside of a proxy. And then with prospectus supplements, I'll just reiterate that one, again, comes with the highest hurdle of them all. This is you drawing down on an existing registration statement. And that hurdle for lawyers and companies to make, not accountants, is going to be fundamental change.
So that's a lot. I said it's a lot to unpack. It is a lot that the registrant will have to deal with. And so kind of switching gears, Liz, like when you mentioned previously the divested business itself, and kind of being prepared. And, obviously you see things in the spin transaction. So SpinCo, what does SpinCo have to do? So talk a little bit about what the standalone reporting requirements might be for that entity, just so people get a flavor for maybe what the impacts might be to these types of transactions.
Absolutely. And I think just the population of things that we normally like to scenario plan for would be maybe a spin, a subsidiary IPO, or just a straight up sale. And you have different readers and buyers of the financial information that you're preparing carve-out financials for. And we'll touch on in a little bit, like how do sellers gear up, get ready for a potential deal without really knowing who the buyer might be or what the transaction actually is. So let's first start off with spins, which are actually my favorite. So in spins, you're filing a form.
You are in the very select few that says spins are my very favorite. Yes.
So, but if you're embarking on a spin, and you might also be doing a dual track, right? So let's assume that you're embarking on a spin only for now. You're going to prepare 3 years of carve-out financial statements. They're going to be audited, and they are going to have, full footnotes. Obviously, you're going to have an MD&A. You're going to have pro formas in there, but it's really trying to show in your carve-out financial statements how the business historically operated under the parent's construct. Right. So there's a lot of, I know Scott's favorite word is there's a lot of nuances.
Mm-hmm.
It's now my favorite. I'm adopting that. There are a lot of nuances here, right? So you're going through a spin and you're preparing carve-out financial statements. There's also technical accounting memos.
Yeah.
You have to think of new segment reporting for your SpinCo, right? All of this while your accounting and financial reporting teams are performing business as usual SEC reporting, right? Assuming we're obviously a public company here. So there's a lot to do and lots to plan. And I think it's pretty similar to subsidiary IPOs. You're likely going to have, an S1 filing for that. You're likely going to have 3 years of historical carve-out financial statements. But here, the timing is so critical, right? Yeah. For spins and for subsidiary IPOs, you're still going through that SEC review comment letter process. Yep. And I can't tell you how many times we've told corp dev teams, when that question asked, how long is this going to take? Put your best estimate down. Well, let's assume 3 or 4 rounds of SEC comment letters for this registration statement process.
Yeah. Yeah. No, yeah. You mean, I think that's a great point, because one of the things the SEC does historically has done from a review program perspective is you have people that, they're looking at new filings or filings for new issuers. And even though, you mentioned the S1 versus whether it could be a 34 Act registrant reporting going to be a Form 10. So it may not be raising capital per se. But again, it is still registering it for the first time. And so the SEC, they're going to look at the Form S1 and the Form 10 in the same way. This is a new issuer, bright light, and there are a lot of people looking at it, a lot of eyes. There certainly is a heavy focus from the staff on getting it right. And of course, obviously it's, the big point, right, is the SEC's obviously you got to think about staleness. What other things to think about there?
They're definitely going to look. So the staleness factor is key, right? Because you're always keeping up. As soon as you, file either confidentially, right, or publicly, you are keeping up with SEC comment letters. But then once it goes to a public flip, you're also keeping up with staleness rules as well. Yeah. So that's certainly tricky, especially because you also have your own SEC reporting requirements, right? So
it's double duty for a period of time.
It definitely is. And people don't realize that as they're embarking into it. Yeah. So not only staleness rules, but I would say that, because you're continuing to keep updating your financial statements, you're getting into a rhythm, right? So you now have all of your technical accounting memos hopefully done. But there is a risk that the SEC might look at your first filing and say, well, show me how you determined your basis of presentation, or show me explain how you've determined your segment determination. Yeah. Right. Yeah. So people really do have to be prepared for this. And that's why obviously advisors, auditors, national offices really do get involved in these types of decisions, because there's a lot of judgment. Yeah.
The other thing is that we would see when I was at the staff would be, you would have something that maybe for the registrant historically wasn't that significant or material to its business, but then as a result of the spin, it's now is, maybe it had not gotten the scrutiny of either the audit firm before and so that tended to be an area that's like, hey, like to your point about documentation, technical memos, that's why it's obviously so important to get all your ducks in a row prior to moving forward. So thinking about, we talked about subsidiary IPOs, but what about a straight sale, right? So, financial buyer, strategic buyer comes in. What are the requirements to think about there?
Well, it depends. It always depends, right?
There's nuances.
And you should probably plan for both, right? Because upfront in a deal, you might not know yet who the acquirer will be.
Right.
So you have to really plan ahead and make sure that the carve-out financial statements, maybe even the diligence or the deal financial statements that you're creating really do cover the whole world of requests that you might get down the line. But there's ways to do that, right? So for a strategic buyer, for example, they might not need audited financials, but they'll still ask for rigorous business analysis through the quality of earnings. Financial diligence will be done. So they're similar to carve-out financial statements or audited carve-out financial statements, but they're going to normalize some things for the quality of earnings like P&L. They're going to look at some of the outer period adjustments, right? So the acquisition might trigger Rule 305, which is the opposite end of what Scott was talking about and requires audited carve-out financial statements potentially for 1 or 2 years. But for financial buyers, the ask can be even broader, right? This is when, for example, a private equity will come in and they might need audited financial statements. They might not, depending on the size. But typically, we see them do ask for audited carve-out financial statements of the business, typically following significance of the SEC rules of 305.
I was about to ask that,
Yeah, but there might also be a debt financing, a debt raise in conjunction with that acquisition that they're making. And in that case, it could likely be any number of years between 1 or 3. We usually see 2 or 3 years being requested and audited. Yeah. So whether it's a private debt raised through an offering memorandum, maybe a 144A, or even an S4 or S3 filing for registered debt.
Yeah. So you mentioned maybe not knowing what the type of buyer might be that you're dealing with. So what does that mean for the seller? Can you provide more insight into that? Like what type of carve-outs are needed?
It provides a lot of frustration and planning up front, right? Because you want to be able to hit all of the bases so early on.
I don't understand how she loves this stuff so much.
I'm a planner, right? But early on, you have to prepare for those multiple outcomes, which means standing up carve-out financial statements that are flexible and agile so that you won't have a deal perimeter that's established yet. Maybe you'll put some more things into it. Maybe you'll exclude them, but you want to get on the same page in terms of what are the possibilities that could go into this deal and then take out later. So you want to get your auditors involved early up front, make sure you understand the materiality level, make sure you understand what top-up testing they might need to do because there's now a chance that your materiality levels are going to go
That's a good point.
way down. So that really means that your auditors are going to be, or you yourself are going to be undergoing an audit maybe for 2 or 3 years in parallel, not just 1 year or one interim period, right? So this is a lot of work. I don't mean to scare any of our listeners here, but it's the planning that's essential, right? I would never recommend waiting to get carve-out financial statements done or pick up the pen and, start them as soon as you really have a concrete deal and you know who your buyer might be or what
it's way too late.
Right? Because now in this age, remember, I started this with the M&A update and I said that deal makers are really doing creative things now. So you might think you're on a path. Maybe you're a serial divester and you've always done sales. Well, now maybe a spin might be on the table. Many of our clients who've only ever done sales are now thinking about RMTs. They're thinking about spinoffs, right? Yeah. So you really have to
Reverse
be prepared.
Morris Trust.
There you go.
Love that reference.
Yeah, I put that in there for you.
That's great. That's great.
But again, never recommend waiting. You risk the delays in the deal, which could potentially leak value. We did a divestiture study a couple of years ago where we studied the impact of not only portfolio bias, but the longer the deal takes from announcement to close, the more value that could potentially be leaked. Remember, we never want the carve-out financial statements and the audit to be the reason, right?
Love that. I love that. So you mentioned earlier too, Liz, basis of presentation. So how do companies figure that out?
Well, this is really hard. I'm going to be honest. This is really hard and I do this every day. Okay. Oftentimes, companies will not really understand the difference between these carve-out financial statements and those deal financial statements. They'll say, oh, well, we already underwent diligence, right? We know what the numbers are. Well, GAAP carve-out financial statements are very different from deal financial statements that go into a quality of earnings. They're a historical look back, but also under US GAAP construct. So for the basis of presentation, we get tons of questions from our clients over, what approach are we in? We have a lot of nuances about maybe businesses that were sold in the past, right? Should they still be in the carve-out financial statements? Or maybe there was an internal transaction. So you basically have two options for the basis of presentation. This will obviously go into any technical accounting memo.
Yep.
Your auditors will take a look at it. But the first is the legal entity approach. And that's where companies define the carve-out perimeter solely based on legal ownership. So if the carve-out is in a single consolidating legal entity, there aren't many nuances to that, then you're probably safe to look at a legal entity approach. But again, there's always nuances because we also have the management approach,
right,
which is where we look at the business and we include and exclude operations of the CarveCo based on how that business was ultimately run by management in the past. So lots of nuances there, right? Because the legal entity approach might be more straightforward from, a data and system standpoint. It's almost like it's akin to a statutory financial statements where you have a couple of legal entities from a jurisdiction. Obviously, you'll have some carve-out adjustments, some from corporate allocations, other things coming in, maybe some other judgments. But the management approach, I think, depending on the transaction, depending on what your deal perimeter looks like, might actually have a lot of judgments to it. Even when you think that you're taking, a certain set of business operations, you're wrapping it up in carve-out financial statements, it still can get dicey when those judgments are applied and you're working with your auditors to be able to substantiate your judgments.
So I was just going to say because we have a lot of conversations on legal entity approach versus management approach, or sometimes referred to as a transaction perimeter approach, right? It's interchangeable with management approach. I guess I would just say on that, they're not necessarily alternatives. Okay. It's not a choice. A lot of times the form of the transaction, the manner in which a company reorganizes in anticipation of a transaction, those will dictate a path.
Yeah.
The key point here is not to get really caught up in the details of these two approaches. It's to say that this is a big assessment and analysis that needs to happen on the front end of these types of transactions. And so that's what we would encourage you to do. Get with your auditors and get with your advisors early to talk about, the basis of preparation.
Especially when you're doing that dual path, the dual track, because there could be some nuances whether this type of deal might require a legal entity approach, whereas another might require a management approach. So how do you do the best with the time that you have and the preparation time?
So thinking about some of the challenges, I want to kind of close with this of just, I think we've got enough takeaways in here that people can listen back and hear. There's a lot really to think about. But when you were talking about some of this stuff, the historical records, how you're thinking, like, can you talk about some of the challenges? And obviously I think you would say they can't be overstated. So what are some of the things to think about?
The main challenge that we see in building carve-out financial statements that are going to be audited is that you're rebuilding financial records from the company from maybe a system that was never intended to produce cuts and slices and dices of data this way historically, right? Everybody says, oh, we got through the K or the Q, we're done. It's closed. We got the opinion, right? You're literally opening up your books and records with a lower materiality where you're going to look at the out of period adjustments. You're going to be potentially going through another audit, right? With a much lower materiality level. So the lack of readily available books and records and the commingling, I'd say as well, in terms of the data, the historical books and records, serves for very challenging times when building carve-out financial statements, because sometimes we see companies don't have a readily available P&L for this type of a carve-out business, right? You generally, maybe it's just, based on a reportable segment or even reporting unit, but now the deal has flipped somehow and you're looking at pieces of a business that have never really been established in this way in your ledger. So that is extremely tricky. And that degree of commingling, the number of legal entities, for example, the global footprint, how much time is it going to take to operationally separate and actually identify these balances?
Yeah.
Right? These are really complicated things. And that really has an impact on the timeline too. On average, with a not so commingled business, it usually takes between 12 and 16 weeks to create, prepare, carve out financial statements and footnotes, and also undergo audit. I know a lot of auditors out there will be very mad at me for that statement, but that is absolutely, here's the disclaimer. That is on average when things are going your way, that you have pretty much a deal perimeter already, you have readily standalone financial information, and you're putting a couple of carve-out adjustments over that, like corporate allocations. You're unwinding a little bit of those intercompanies, identifying those intercompany balances. But again, that's not
easy.
It's not easy, but then it gets much harder, right?
Yeah.
So
look, I think it really highlights it. Look, it is a technical exercise at some point in time, but when you're looking at these M&A deals, you're looking at acquisitions and divestitures. It really is sophisticated planning, involving the right people early on, but ensuring, right, that you have the flexibility, right?
That flexibility is so important.
I love that point.
Because for our advisory clients, we've built some incredible tools and proprietary algorithms that make the carve-out process, when you don't have that readily available information, it goes so much smoother, right? To be able to identify what those balances are and roll them forward for the other periods.
Yep. Scott, any takeaways to add here?
More nuances.
A lot.
I don't think so. I would just say, I mean, it might feel like we went really deep here. I would say we didn't.
No, I know.
Right? There's a lot more. There's a lot more to it. So I think I would maybe just close with one of the thoughts that I expressed earlier, which is this is inherently non-recurring, and so even sophisticated clients are not dealing with these types of whether they're technical or practical. They're just not dealing with it all the time. Okay, and so I think I would just reiterate my encouragement that if you find yourself on the front end of an acquisition or a divestiture, you would be really well served to, engage in those conversations again with advisors, auditors, lawyers, et cetera, at a very, very early stage to anticipate the requirements.
Well said. Liz, Scott, thank you so much for your time. That was fantastic. A lot of great contact there, and looking forward to another time that we can do this. Thank you so much.
That's our show for today. Tune in next week for more fresh episodes. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all our latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors, including accountants and lawyers.